The stock market is often seen as a mix of logic, emotions, and sheer luck. Renowned investors and financial thinkers have shared countless witty and humorous observations about the behaviors of investors, their quirks, and the unpredictable nature of the markets. These remarks not only provide amusement, but also carry underlying truths about human psychology, greed, fear, and irrationality in the financial world. From Warren Buffett's dry humor to Peter Lynch's sharp insights, the commentary on stock market investors is as entertaining as it is enlightening. Warren Buffett, often called the Oracle of Omaha, has a treasure trove of memorable quips about the stock market. One of his most famous lines, "The stock market is a device for transferring money from the impatient to the patient," succinctly captures the folly of impulsive investors who chase quick gains. Buffett's humor often points out the paradoxical behavior of investors, like his observation that forecasts may tell you a great deal about the forecaster. They tell you nothing about the future. This reminds us that no matter how confident an analyst may sound, the market's next move is anyone's guess. Charlie Munger, Buffett's right-hand man, is known for his sharp wit. He once said, "A lot of people with high IQs are terrible investors because they've got terrible temperaments." Munger's comment highlights the irony of brilliant minds succumbing to emotional mistakes in the market. He also joked, "The big money is not in the buying and selling, but in the waiting," poking fun at the impatience of many investors who overtrade in the hopes of beating the market. Peter Lynch, a legendary mutual fund manager, has also contributed his share of humorous observations. He once remarked, "Investing without research is like playing poker and never looking at the cards." This line mocks the casual attitude of investors who dive into stocks based on rumors or hype rather than sound analysis. Lynch also commented on the unpredictability of the market with, "Everyone has the brain power to make money in stocks. Not everyone has the stomach." This humorous take emphasizes that emotional discipline is often more important than intelligence when it comes to investing. Benjamin Graham, the father of value investing, had a knack for highlighting investor irrationality with wit. He famously said, "The stock market is a voting machine in the short term and a weighing machine in the long term." This analogy humorously underscores the market's short-term fluctuations, driven by popularity contests among stocks, versus its long-term focus on fundamentals. Graham's humor often served as a gentle nudge to investors to keep their cool amidst the market's chaos. John Maynard Keynes, an economist and keen observer of financial markets, once remarked, "The market can stay irrational longer than you can stay solvent." This dry comment reflects the frustration of investors trying to apply logic to an inherently illogical system. Keynes also mocked herd mentality with his analogy of the stock market as a beauty contest, where success depends not on picking the most beautiful contestant, but on guessing who others think is the most beautiful. Another gem comes from George Soros, who remarked, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." His comment humorously acknowledges that even the best investors are frequently wrong. It's the net result that matters. Soros's wit often reflects the paradoxical nature of investing, where success often stems from unconventional thinking. Then there's Paul Samuelson, the Nobel laureate in economics, who said, "Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas." His comment humorously highlights how successful investing is often boring, contrasting sharply with the thrill-seeking behavior of many investors. It's a reminder that chasing excitement in the stock market usually leads to disappointment, or worse, losses. Wall Street itself has been a source of endless humor. The financial journalist Adam Smith, a pseudonym for George J.W. Goodman, once quipped, "If you don't know who you are, the stock market is an expensive place to find out." This witty remark captures the self-discovery and often self-delusion that comes with investing. Similarly, Will Rogers joked, "Don't gamble. Take all your savings and buy some good stock and hold it till it goes up, then sell it. If it don't go up, don't buy it." His circular logic pokes fun at the simplistic advice often dished out to novice investors. Mark Twain, though not an investor, had plenty to say about speculation, remarking, "October. This is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February." Twain's humor captures the universal truth that there's no safe time to gamble on stocks, as every moment is fraught with uncertainty. Even modern investors and commentators have their share of zingers. Jim Cramer, the boisterous TV personality, often jokes about the absurdity of market predictions. "There's always a bull market somewhere," he says, mocking the media's constant search for silver linings. Similarly, investor Howard Marks wryly observed, "You can't predict, but you can prepare," a humorous jab at the overconfidence of market forecasters. The humorous remarks of these investors reveal a common thread. The stock market is as much about psychology as it is about numbers. Investors are prone to irrationality, herd behavior, and the endless pursuit of shortcuts, all of which provide fertile ground for witty commentary. Beneath the humor lies a deeper wisdom. Successful investing requires patience, discipline, and a sense of humility. After all, as Warren Buffett once quipped, "Only when the tide goes out do you discover who's been swimming naked."